Welcome to the Explainer, everyone. Today we're diving into a massive, literally world-changing what-if scenario. We're going to explore the incredibly complex idea of the United States and the United Kingdom deciding to share a single, unified monetary system.
I want you to just imagine this for a second. A world where the US dollar and the British pound simply no longer compete. Imagine waking up to find that Washington and London have ditched their separate financial identities, and instead, they've formed a single shared unit of money that you and I would use every single day. On the surface, sure, it might sound like a neat, futuristic financial reform, but as we're about to unpack, it's actually a logistical and geopolitical minefield.
Okay, let's dive into this. You see, as our source points out, currency is never just paper or numbers on a screen or digital code. Currency is sovereignty. Above all else, it's about trust. It represents a nation's history, its politics, its pride, and its very identity, all rolled up into one system that dictates everything from your weekly wages to global trade. So the stakes of this thought experiment, they are sky high. Because changing how money works means fundamentally changing how two great nations define themselves.
Section 1, the $1 trillion announcement, and day 1 of the shockwave.
Picture the exact moment this shared currency drops on the news. The immediate chain reaction would be absolutely explosive. I mean, global headlines would just ignite. Central bankers everywhere would freeze in their tracks, having to recalculate the entire global order on the fly. Journalists and financial markets would instantly start speculating. Is this just a practical upgrade or the birth of a massive new economic bloc? And overnight, ordinary citizens like us would be lying awake, worrying about our bank accounts, our savings, and our debts. Would everything just convert instantly?
Well, the very first major impact would be heavily psychological, sparking some incredibly intense domestic political debates on both sides of the Atlantic. American skeptics might seriously fear a loss of their global autonomy. After all, the dollar symbolizes U.S. global power and domestic confidence. Meanwhile, British skeptics would likely fear surrendering centuries of independent financial tradition that's entirely wrapped up in the pound. Blending these two identities would force both nations to ask some pretty tough questions. Who actually controls this new system? And honestly, whose inflation matters more?
Moving on to Section 2, merging two financial giants and the technical reality.
And this brilliantly illustrates the massive challenge here. Merging these systems means trying to align two completely different economic rhythms and labor markets. You'd basically have to synchronize the Federal Reserve and the Bank of England under one single rulebook. But look at the sheer contrast. The United States has this giant, deeply diverse economy spread across 50 states, holding a central role in global reserves. The United Kingdom, on the other hand, is smaller, but it is deeply, deeply linked to international finance, services, and trade. It's like trying to perfectly sync two entirely different heartbeats.
So, what does this all mean? Well, it brings us to a severe structural conflict when it comes to monetary policy. Think about it. If one nation enters a nasty recession while the other is absolutely booming, whose problem wins out? If one side desperately needs low interest rates to save jobs, but the other side needs high rates to cool off inflation, who has to compromise? A shared currency is really only efficient if the economies are aligned enough to tolerate the exact same rules, which would require an intense, permanent level of coordination.
Section 3, a new global superpower and the geopolitical tsunami.
Now zooming out to the macro level. This internal monetary merger would instantly trigger a geopolitical tsunami. In theory, multinational firms operating in both countries would absolutely love this. I mean, a shared currency completely reduces exchange rate friction. No more hedging against those pesky pound-dollar fluctuations. Businesses would save a ton of time and money, making cross-border investment vastly simpler and seamlessly connecting the two nations. But here's the catch. What looks like a simple internal convenience instantly becomes a massive flex of external power.
The global market would have to adjust to this new economic superzone right away. This isn't just an economic shift, folks. It's a major strategic repositioning that binds the US and UK's futures together against any external shocks. The European Union would be watching very carefully, definitely sweating a bit over euro stability and where capital is flowing. China and other global powers would interpret this strategically, seeing a highly resilient new financial access. And global investors? They'd immediately start weighing the reserve status of this new currency.
Which brings us to a really crucial concept, the reserve currency. Would this new transatlantic asset actually be stronger than the dollar? You see, a reserve currency relies entirely on stability, liquidity, and predictability. The world rewards predictability, not just cool symbolism. So the success of this new asset would depend 100% on the high discipline and clear policy rules of its new institutions, because trust, once it's shaken, is incredibly hard to rebuild.
Section 4. The Everyday Citizen Impact and the Human Aftermath.
Now, what's really interesting about this slide is seeing exactly what citizens actually care about. How does this macroeconomic earthquake hit your wallet? Because let's be real, most people aren't sitting around thinking about global monetary architecture every day. We think about groceries, rent, gas, our wages, our savings, and our loans. The biggest question for anyone is simply, do I have more or less money than I did yesterday? Public patience for these grand visionary ideas vanishes the exact second it touches the price of dinner.
To actually get this system running, the banking sector would have to go through a brutal period of adaptation. We are talking years of upgrading ancient software systems, aligning complex payment rails, and unifying ATM networks and payroll platforms. And here's the terrifying part. Just one tiny digital glitch, like a delayed salary or an ATM randomly swallowing your card, can instantly trigger massive public panic. Modern money is essentially just software, and if that software stutters, people freak out about whether their wealth is actually real.
And then, oh boy, there is the issue of debt. Every single mortgage, government bond, student loan, and corporate debt would have to be painstakingly reviewed for conversion terms and legal jurisdiction. Hidden losses in debt conversion are basically a death sentence to public trust. If citizens even suspect that the new rules favor one side over the other or feel like their debts unfairly grew overnight, that resentment is going to completely poison the entire union.
There's also a surprisingly emotional impact to consider here: the aesthetics. Currency notes and digital interfaces carry national imagery, cultural memory, and icons. Would Americans actually be okay with British design influence on their money? Would Britons accept a redesign that feels totally dominated by Wall Street? A loss of that familiar imagery actually feels to a lot of citizens like a direct loss of their own identity.
Even something like travel would radically change. Internal travel between the US and the UK would become incredibly fluid and seamless, really deepening the cultural connection and making the two nations feel like one big shared economic space. But global travel? That becomes vastly more complex. Your purchasing power overseas would now rely entirely on the strength of this brand new currency standard. It's a complete reallocation of economic gravity.
Section 5. The ultimate price of trust and measuring value together.
So let's bring this all together and summarize these massive structural and psychological hurdles. The long-term possibilities here are absolutely fascinating. This hypothetical scenario would essentially act as a giant proof of concept for global financial alliances for decades to come. If it succeeds, other allied nations might actually join this transatlantic architecture. But if it fails, the collapse would be so disastrous that future monetary unions worldwide would seem way too risky to ever attempt again.
So, the crucial point is that a beautiful concept is simply not enough. Currency needs strict, unyielding order. To survive, it requires aligned inflation behavior, mutual fiscal discipline, completely clear rules for monetary leadership, and a deep, radically restructured framework of governance and public legitimacy. Without that deep institutional discipline, the whole thing becomes unstable incredibly fast.
Ultimately, we have to remember that money is deeply personal. It's literally how citizens measure their effort, their security, their rewards, and their possibilities in daily life. People naturally resist changes to money because a new currency feels like a brand new rulebook being forced onto their lives. A shared currency demands trusting not just a new financial system, but an entirely new international partnership.
Which leaves us with one final, pretty profound question to chew on. Can two great powers truly share the very medium through which they measure value? It's not just about sharing paper notes and digital numbers, it's about sharing a living expression of trust and control. I really want you to think about that and definitely let me know your thoughts on this whole scenario down in the comments. Thank you so much for joining me for this explainer, and as always, keep questioning the systems that shape our world.